There are businesses in Australia right now worth hundreds of millions of dollars that you have never heard of. No logo you'd recognize. No founder on a podcast. No product launch anyone wrote about. Just cash. Arriving every month. Quietly. Reliably. From businesses so unglamorous that most ambitious people walk straight past them. That is exactly how a holding company gets built. And today I'm going to show you how it works, level by level, from the first $500,000 asset to the structure that crosses $500 million. Most people never build one. Not because they lack intelligence. Because they reach for the wrong thing first. Let's fix that. A holding company is not a startup. It is not a pitch deck. It is not a brand with a mission statement about disrupting an industry. It is a legal structure that owns other businesses and uses the cash those businesses generate to buy more businesses, and repeats that process until the math becomes genuinely hard to look at without blinking. The entire premise fits on a napkin. Buy businesses that produce predictable cash. Use that cash to buy more businesses. Compound forward until the portfolio is large enough to refinance, recapitalize, or sell at a multiple that changes the financial trajectory of your family for generations. In Australia, the most common structure for this is a proprietary limited company sitting at the top of the chain, your holdco, with individual operating companies sitting beneath it. Each operating company runs its business. Profits flow up to the holdco. The holdco allocates capital across the group and makes the next acquisition. The tax efficiency in this structure is significant. Intercompany dividends flowing between related Australian companies are generally tax-free under the tax consolidation rules. That means profits generated in operating company A can flow to the holdco and be redeployed into a new acquisition without a second tax event. That single structural advantage is why sophisticated Australian business builders use the holdco structure rather than owning operating businesses directly. Now, level 0. The engine question. Before you look at a single deal, before you draft a letter of intent, before you spend money on a quality of earnings report, you need to answer one question. Where does the first cash come from? The businesses that reliably fund a level 0 holdco in Australia share specific traits. They are not exciting. That is precisely the point. Commercial cleaning businesses with office park contracts. HVAC servicing and maintenance with annual service agreements. Pest control on recurring residential contracts. Niche business-to-business software with annual subscription models and switching costs that make customers stay. Labor hire firms in industrial sectors. Businesses that win contracts, not audiences. The businesses worth acquiring first are the ones boring enough that no venture capital firm is trying to disrupt them. Nobody is raising a Series A to revolutionize commercial refrigeration maintenance. That's the point. The moat is the lack of glamour. Before you touch a deal, you need a buy box. A written, non-negotiable document that defines what you will and will not look at. Without it, you will spend 6 months doing due diligence on deals that were never right for you because excitement dressed them up and you wanted to believe. At level 1 in the Australian market, your buy box should look roughly like this. No single customer representing more than 20% of revenue. The day that customer leaves, your cash flow doesn't dip. It collapses. Customer concentration is the most common hidden risk in Australian SME acquisitions. EBITDA margins above 15% after legitimate owner add-backs. Below that, there isn't enough oxygen in the business to service acquisition debt and fund operations simultaneously. Purchase price between $500,000 and $2 million. This is the range accessible through a combination of your own capital, vendor finance from a seller, and senior debt from an Australian bank or non-bank lender before you've built the track record to access institutional capital. A business that runs with an existing operator. You are not buying yourself a job. You are buying a cash-producing asset that functions without you standing in front of it every morning. Now the question everyone avoids because they're embarrassed they haven't solved it yet. How do you build credibility when you have no capital and no track record? The answer is that credibility at level 1 is not money. It's demonstrated judgment. You build an advisory bench. People who have operated or exited businesses in your target sector in Australia. Former business owners, industry accountants, retired operators. They don't need to invest. They need to be willing to have their name associated with your judgment. You structure a search arrangement with an operator partner. Someone who runs the business in exchange for equity and salary while you handle the capital structure and the acquisition process. That alignment gives sellers and lenders something to underwrite beyond your personal balance sheet. You do a consulting engagement with a business owner thinking about succession. Prove your operational ideas work before you ask anyone to stake you. Track record built from proof rather than promises. None of it works without baseline financial literacy that most people think they have and don't. There is a specific trap waiting for you at level 1. It is called working capital, and it will catch you off guard if nobody has warned you to look for it. EBITDA is not cash. You will look at a business showing $400,000 in EBITDA and feel excited. Then you will look at the cash flow statement and realize the business invoices on 60-day terms and pay suppliers in 30 days, which means it is constantly consuming cash just to operate. Profitable on the P&L, starving in the bank account. In Australia, trade finance facilities, debtor finance, and invoice factoring exist specifically to bridge this gap. But you need to know the gap is there before you buy the business, not after. Before level 2 becomes possible, you need an operating system inside your first acquisition. Monthly reporting. A KPI dashboard covering revenue, gross margin, customer count, churn, and cash on hand. And a simple capital allocation rule for every dollar the business generates. A portion reinvested into the operating business. A portion reserved for the next acquisition. A portion held as a liquidity buffer you don't touch unless something breaks. 3 buckets every month. Without that structure, profit becomes lifestyle before it becomes leverage. You spend years working inside the business instead of building above it. Level 2. The first acquisition. The first deal teaches you everything the books got wrong. Not because the books are lying, because the books describe the process. And the process is not the problem. The problem is the version of yourself sitting across the table from an Australian business owner who built something over 20 years and needs to believe you are the right person to carry it forward. Deal sourcing in the Australian market is different from the US. The broker market is smaller. The pool of business owners considering succession is large. Over 60% of Australian small business owners have no formal succession plan despite their business representing the majority of their personal wealth. That creates genuine proprietary opportunity. 2 channels worth building early. The first is direct outreach to business owners before they've engaged a broker. Researched, targeted, specific. You know the owner's name. You know how long the business has been operating. You know the industry. You say something specific about why you're interested. You are not pitching. You are opening a conversation. The second channel is business brokers. But understand what Australian business brokers actually are before you use them. Their obligation is to the seller. Their job is the best outcome for the vendor. If you want quality deal flow from brokers, you need to be the buyer who closes. Fast, clean, without retrading after due diligence. Brokers talk to each other. A reputation for being difficult or slow will close your access within a year. A reputation for being decisive and credible will put you on the shortlist before a listing goes to market. Now the valuation conversation. In the Australian SME market, most businesses trade between 3 and 6 times EBITDA depending on sector, customer concentration, operator dependency, and whether the business is contracted recurring revenue versus project-based or transactional income. Businesses with contracted recurring revenue and low churn trade at the top end. Businesses dependent on the owner's relationships or a single major client trade at the bottom. But the multiple on the term sheet is not the deal. The structure of how you pay that multiple is the deal. A vendor finance note, where the seller finances part of the purchase price, paid from the cash the business generates over time, is your most powerful tool at this stage. It aligns the seller's interest in your success. It preserves your capital for operations. And it signals to senior lenders that the person who knows the business best is willing to leave money in it. An earnout ties a portion of what you pay to future performance, which is useful when the seller believes the business will grow and you want to hedge against a story that doesn't materialize. Structure beats price. A lower headline number with a favorable vendor note and a working earnout can be worth more than a clean cash deal at a higher multiple that drains your liquidity on day one. Due diligence is where the deal confirms or collapses. The single most important thing you're doing is adjusting EBITDA for what's real versus what's presented. You are looking for owner add-backs that aren't legitimate. Personal expenses run through the business. Family members on payroll who don't work. A vehicle fleet that services the owner's lifestyle more than the business. You are looking at customer retention across 3 to 5 years. A business with 90% annual customer retention is a fundamentally different asset from one with 60%, even if the revenue looks identical on a single year's profit and loss. You are checking for deferred maintenance, aged equipment, lease expiry risk, employee entitlement accruals, and tax exposure the seller hasn't mentioned. You are reading contracts, not summaries of contracts. Get a quality of earnings report done by an Australian accounting firm that does transaction advisory before you close anything meaningful. The cost is several $1,000s. The alternative is discovering a liability 18 months after settlement. Level 3. Building the machine. You have 2 or 3 businesses. Cash is flowing. Debt is servicing. Operators are in place. This is where most people stop building and start administering. And those are not the same thing. The transition from a portfolio to a machine starts with a decision most people avoid making because it closes doors. You have to choose a vertical. Home services. Industrial distribution. Allied health. Business-to-business software. Healthcare ancillary services. Trade services with commercial contracts. Whatever vertical you choose, you go deep before you go wide. You buy the anchor business. Then you tuck in smaller businesses that extend your geography, add capability you don't have, or bring in customer segments you haven't reached. Each tuck-in costs less than a standalone acquisition at equivalent size because it's stepping into infrastructure that already exists. That is structural compounding, not financial compounding. The machine compounds because each part makes the other parts more valuable. Build shared services without creating the bureaucracy that kills the operating culture inside your businesses. Finance, payroll, insurance, IT, procurement. These cannot be reinvented at every entity in the portfolio. One insurance broker negotiating for 5 businesses. One payroll platform. One accounts payable cycle. One group-level banking relationship with a major Australian bank that improves your borrowing terms across the whole portfolio. The businesses inside your group should feel like they have resources they couldn't afford independently. If your shared services feel like head office interference instead, you've built it wrong. Risk management is not optional the moment you have real leverage in the system. Set concentration limits. No single business representing more than a certain percentage of total portfolio EBITDA, because the business that generates 60% of your cash flow is also your single largest vulnerability. Set leverage limits. A downturn in one asset should not cascade into a covenant breach that threatens the rest of the group. Hold cash reserves. Not because you're afraid of opportunity. Because the Australian holding company that survives a recession is the one that bought assets from the ones that didn't. Run scenario planning quarterly. Not to predict what will happen. To see the dependencies you've stopped noticing. And at every layer, retain and incentivize the operators who make the businesses function. Your best operators need to think like owners. Equity participation. Profit sharing tied to multi-year outcomes. Something that makes staying worth more than leaving. The machine doesn't run because you're working harder. It runs because you built it to run. Level 4. $500 million. When the portfolio crosses into institutional territory, the rules that got you here become insufficient. The people across the table are no longer regional lenders and local sellers. They are family offices with more assets under management than the GDP of a small country. Institutional private equity. Infrastructure funds looking for stable yield. Strategic acquirers for whom your portfolio represents capability they'd rather buy than build. What they are pricing is not the revenue. It is the durability of the cash flows. The quality of the management bench that runs without you. The systems that produce consistent reporting. The track record of acquisitions that performed as modeled rather than disappointing after close. The concentration of risk at the portfolio level. And the answer to the question every institutional buyer asks before they write the check. Does this machine run if you leave? If the answer is yes, you have built something worth $500 million. If the answer is no, you have built a complicated job with good margins. The difference between those two things is not the revenue. It is the architecture. Build the architecture. The revenue follows. If this gave you a real framework for how Australian holding companies are actually built, hit the like button and subscribe. I'll see you in the next one.